Welcome to your guide on building an investment portfolio for long-term success. Many new investors feel overwhelmed by the sheer number of choices and the complexity of financial markets, but with the right approach, you can take control of your financial future. In this video, we'll break down the process into clear, manageable steps, helping you understand how to set goals, choose the right asset allocation, implement your plan, and maintain it over time. Whether you're saving for retirement, a child's education, or another major milestone, this journey is about making your money work as hard as you do. Let's get started by exploring the foundational step, setting your investment goals. Every successful investment plan starts with a clear goal. Ask yourself, what are you investing for? It could be retirement, buying a home, funding your child's education, or leaving a legacy. The more specific your goal, the better. For example, instead of saying, I want to retire someday, try, I want $2 million in today's dollars by July 1, 2040. This clarity helps you determine how much you need to save and by when. Remember, goals can change as life evolves, and that's perfectly normal. The key is to start with a plan and adjust as needed, rather than never starting at all. In setting your investment goals, it's important to consider inflation. If your goal is more than 5 years away, you should use after inflation or real numbers. This means calculating how much you'll need in today's dollars, not just future dollars. For example, if you need $100,000 a year in retirement, that's $100,000 in today's money, even if you retire 20 years from now. Adjust your savings and expected returns to account for inflation, ensuring your money maintains its purchasing power over time. Once you have a goal, it's time to estimate how much you need to save. For simple goals like buying a house, this might be straightforward. For complex goals like retirement, you'll need to estimate annual spending, subtract expected income from pensions or Social Security, and apply a safe withdrawal rate, typically 3% to 4.5% per year. For example, if you need $70,000 a year from your portfolio, dividing by a 3.5% withdrawal rate means you'll need $2 million saved. These calculations help you set realistic savings targets. Your ability to reach your goals depends on both how much you save and the returns your investments generate. These two factors are closely linked. If you can save more each year, you may not need as high a return to reach your target. Conversely, if you save less, you'll need higher returns, which often means taking on more risk. Use tools like the future value function in spreadsheets to experiment with different scenarios and see how savings rate, time, and expected returns interact. Market returns are unpredictable and largely out of your control. While you can estimate expected returns based on historical data, remember that past performance is not a guarantee of future results. For example, the US stock market has historically returned about 6% after inflation, while bonds have returned less. It's important to use realistic return assumptions, typically between 2% and 7% after inflation, when planning. Avoid overly optimistic projections, as they can lead to disappointment and missed goals. Given the uncertainty of market returns, the most reliable way to reach your goals is to save more money. If you want $2 million in 25 years, you'll need to save between $31,700 and $65,500 per year, depending on your expected return. The riskier your portfolio, the less you may need to save, but higher risk also means greater uncertainty. Focus on what you can control, your savings rate, and let compounding work in your favor over time. After setting your goals, the next step is to decide how to allocate your investments among different asset classes. Asset allocation is the process of dividing your portfolio among categories like stocks, bonds, real estate, and cash. The right mix depends on your goals, risk tolerance, and time horizon. A well-diversified portfolio can help manage risk and improve your chances of reaching your objectives. Remember, there's no single perfect allocation. Many combinations can work as long as you stick with your plan. Ideal asset class has three main features: a positive long-term return, low correlation with other assets, and enough diversification within the class. You don't need every asset class. 3 to 7 is usually enough for most investors. Common asset classes include US stocks, international stocks, bonds, real estate, and cash. Adding more classes increases complexity and may not always improve performance. Consider your own access to unique asset classes such as employer stock or specialized funds, but keep your portfolio manageable. Let's briefly review the major asset classes. Cash includes savings accounts and CDs, safe but low return. Bonds are loans to governments or corporations, offering moderate returns and lower risk. Stocks represent ownership in companies and have higher potential returns but more volatility. Real estate can provide income and diversification. Alternative investments like commodities or private equity are available but often add complexity and risk. Most investors can build a solid portfolio using just stocks, bonds, and cash, with real estate as an optional addition. Stock-to-bond ratio is the most important decision in asset allocation. Stocks offer higher returns but more risk, while bonds provide stability. A common rule of thumb is to subtract your age from 100 to find your stock percentage. For example, a 30-year-old might have 70% in stocks and 30% in bonds. Adjust this based on your risk tolerance and investment horizon. Remember, it's better to be slightly conservative than to take on more risk than you can handle, especially during market downturns. Including international stocks in your portfolio can provide valuable diversification. Different economies and markets don't always move in sync, so international exposure can reduce risk and potentially enhance returns. A reasonable range is to allocate 20% to 55% of your stock investments to international markets. The exact percentage is up to you, but having some international exposure is generally recommended for most investors. Your asset allocation decided, it's time to choose specific investments. You can select individual stocks and bonds, but most investors prefer mutual funds or ETF for diversification and simplicity. Passive index-based funds are usually the best choice. They're low cost, easy to manage, and have a strong track record. Decide which accounts to use, such as IRAs, 401(k)s, or taxable accounts, and place your investments in the most tax-efficient way possible. The key is to follow your plan and avoid chasing trends. Building your portfolio is just the beginning. To stay on track, you need to monitor your progress and make adjustments as needed. Track your investment returns at least once a year and compare them to your goals. Rebalance your portfolio periodically to maintain your desired asset allocation, especially after significant market moves. Only make major changes to your plan for good reasons, such as a change in life circumstances or a new long-term strategy, not in response to short-term market swings. Most important part of investing is consistency. Stick to your plan through market ups and downs and avoid the temptation to tinker or chase performance. Over time, disciplined investing and regular saving will help you reach your financial goals. Remember, there's no perfect portfolio. What matters most is having a reasonable plan and following it. With patience and persistence, you can build lasting wealth and financial security for yourself and your loved ones.